Hey folks, welcome back to the channel. My name is Jason. I'm the host of Fighting Words Financial. Let me know if you guys can hear me out there. Sitting here in Southern California, where it seems pretty apparent now that the apocalypse is nigh because it's about to rain at my house, and everyone knows there's no rain in Southern California. That is not an exaggeration. In the summertime, usually it doesn't rain. But I did want to talk today about some signs in the economy, increased risk of recession. And I've tried to present both sides of this that, there are some economists saying that the chances of recession are less than 50%. There are some folks that are saying that it's greater than that. I think that we actually are currently in a recession right now. Some of our right now, when we estimate whether or not we're in a recession, remember, we're looking at trailing data in a lot of cases. That data is from last month or even last quarter. So based on the textbook definition of whether or not we're in a recession, we definitely are. And it's, if you're just saying it's simply 2 quarters of declining GDP. If you look at the economy a little more holistically based on current data, or at least trailing data from a month ago, maybe you wouldn't say that, right? Because consumer demand looks still good. The labor market is very strong. And those are things that indicate that we still have a healthy economy. Now, a lot of that demand for products and a lot of the increased spending is being absorbed by inflation right now. And that's the major risk to our economy. Just looking at this over the last year or so, I've been pretty slow to accept that inflation is going to be persistent, but we actually run the risk here right now of what I think is a double dip recession, or perhaps sort of a longer period of muted economy where we see 2% or less GDP growth per quarter going on for a few years, largely because I'm not sure that the Federal Reserve is really going to have the stomach to really cause demand to decrease significantly by increasing the unemployment rate as much as they probably should. And that's really the way that they're trying. That's really what they're trying to do with restricting liquidity by raising interest rates. Now, I've said it before in the past that the federal that not the federal government, but the Federal Reserve is perfectly willing to sacrifice the stock market in order to achieve that, because long-term inflation is a much greater concern than asset prices are today. But they do want long-term wise, they want asset price stability. I'm not just talking about the stock market. I'm talking about commodities and all that too. But there are risks of recession. And this interview here with Mohammed Al-Aryan, now Mohammed Al-Aryan is sort of a perpetually pessimistic pundit who who talks a lot on television. He's interviewed a lot, and I listen to him a lot when he talks about the bond market, of course. But he says, and you don't have to agree with everything the man says. No, you never should. There are plenty of economists on the other side of the fence from him at all times. But he claims that the risk of recession is getting higher and higher, and that his definition also for recession is more of a holistic definition. It goes beyond 2 quarters of negative GDP. He claims that the labor market is just too strong, meaning that labor has a lot of negotiating power when it comes to wages right now. And we're seeing a lot of wage inflation. Consumer spending is too strong, and business balance sheets are too strong. We are simply not in a recession. Is the risk of recession high? He claims that yes, it is high, and it's getting higher. Now, he highlighted the Federal Reserve's monetary tightening policy, slowing the economy right now, and the IMF's recent forecast showing that all major areas of the global economy are slowing right now, calling the conditions gloomy and uncertain. I would definitely call everything uncertain right now. Gloomy, maybe not so much. Arian says, in order for the U.S. to stop, in order for us to stop the U.S. from slipping into recession, that's be 4 measures in particular that need to be taken. First and foremost, we need to get control of the inflation beast. I'm of the opinion that it's going to be very hard to get control of the inflation beast without throwing us into recession, or at least a longer period of where inflation is slightly elevated and unemployment rates are slightly elevated. That would be the mythical soft landing, which the Federal Reserve generally does not achieve. It's usually a much harder landing than they anticipate. So the Fed needs to act not only in tightening monetary policy, but also regaining credibility, according to Al-Aryan. In July, we had a 75 basis point raise. He claims this is basically not going to be enough. He also claims that they need to target fiscal policy more to protect the most vulnerable segments of our society. This has massive economic and social and political consequences. Of course, he offers no suggestions as far as how that is going to go. He suggests pro-growth, pro-productivity reforms that need to be done. including to increase labor force participation. So that was very interesting. Looking at labor force participation, we're looking at historical averages here. Um, Historical average is right around 62% or so. We're right at about 62%, less than 0.2 percentage points away from the highest participation rates that we've had in a very, very long time. If we look over a 5-year period, it's slightly lower than we were, let's say, at the beginning of 2020, right before the pandemic occurred. So they would have been, it was close to 63.5%. Now it's at 62.2%. There's a lot of articles and a lot of research stating out there that a lot of baby boomers who were close to retirement chose to retire early during 2020 with a combination of pandemic spending packages and unemployment being extended to everyone. About 1 million people left the economy and just aren't returning. So in terms of labor force participation right now, we are pretty high or pretty close to historical averages right here. It's not that much lower than, say, this trend line right here, just below 63% at 62.2%. If we look at the max, the highest participation rate was right here in the year 2000, and it's been declining ever since then. And that has a lot to do with the largest generation ever in the history of America, the baby boomers, actually leaving the workforce, and they're not being replaced fast enough. So to me, this is not a surprise, and I'm not sure how much higher we can get than this peak of 2019 of labor force participation. And I think it was 67.6% was the highest labor force participation rate we have ever seen. So I don't think that's going to happen with any change in policy, just because there aren't the people available to do that. And he also talks about better risk management, saying, let's not forget financial stability. Let's not forget how risk has not only morphed and migrated from banks to non-banks, but non-banks have been encouraged by years of zero interest rates and massive predictable liquidity injections to go well beyond the native habitat and risk taking. And I understand what he's talking about there. He's talking, it used to be that investment banks and banks were the ones that took most of the risk in the economy, and other businesses have been borrowing for quite some time in order to expand out there. So the non-banking sector is still offside. We have to keep an eye on the financial stability risk, because that could come back and harm the economy. So that is one opinion there. So looking at markets today, it looks like the NASDAQ is up just barely. Looks like the Dow Jones is down just barely. That is mostly led by energy, which was down almost 4% here. And that has a lot to do. And this is another one of those signs that inflation is affecting things, but it may have peaked already. This is one of those signs, or a couple signs here, that we may not be entering into a recession. Or on the other side of that coin, it may be that futures markets are pricing in a recession 6, 9, 12 months from now. The consensus seems to be from various different firms. I looked at a bunch of literature this morning that we have about a 50% chance of going into a recession sometime in the next 18 months. And I do want to talk about something a little from Bridgewater Capital here in just a moment as well. So mortgage rates fell below 5%, which is the lowest level since April. And that's significant. They were over 6% just a few weeks ago. And oil prices fall below $90 a barrel. A lot of this has to do with the oil futures market. But oil falls below $90 a barrel for the first time since the Russia invasion of Ukraine. We have not seen a decline in production. We're not seeing a decline in crude oil making it to the market. We're seeing more and more of that happen. There may be a softening in demand. There may not be a softening in demand. But most of this, I think, actually has to do with the oil futures market. So Texas crude has lost 9.4%, the largest 1-week percentage decline since April. A break below $90 is quite remarkable, given how tight oil market remains due to a shortfall in supply. Once again, we're not seeing a decrease in supply. We are seeing an increase. So inflation peaking, that is something that Elon Musk talked about earlier today, and Bill Ackman has talked about as well. I would possibly agree that inflation might be peaking, but there are a couple of really big risk factors that are out there right now. Number one, the big risk factor being out there is, of course, geopolitical disturbance because of the war in Ukraine, because of the tensions with China. But number two, we're probably going to be going into one of the most active hurricane seasons that we've had in a decade. These storm predictions are usually not all that accurate, but they're predicting right now that we might have 11 named storms hit the U.S., and most of those usually occur in the Gulf of Mexico which is where most of the nation's oil refining is done, which would impact global oil supplies and fuel supplies here in the U.S. So those are the two major risks going into the fall. As we get deeper into the fall, a bigger risk, I think, is actually geopolitical, and that's where natural gas is going to start becoming very, very important to Europe, and Russia is going to be able to mess with Europe's gas supply. I'm sure they're all making plans to wear sweaters in the wintertime at home. Not every country in the European Union is dependent on Russian natural gas, but the largest member, Germany, has a lot of dependence on Russian natural gas, and of course, a lot of countries in Eastern Europe. So those are still two risks to energy shocks that could keep inflation going here. So those are some of the things I wanted to talk about today. The big thing is that we're talking about when it comes to technology news is that Tesla's annual meeting starts today, and here are a few things to watch on that. So they want to hear from Elon Musk, of course. Everyone likes to hear from when he talks about Tesla. They produced a record number of vehicles in June. They're ramping up production at new plants in Germany and Texas. He's going to talk about how those ramps are going. I did, somebody in my Patreon group submitted an article or posted an article in our Discord talking about the giant giga presses that are being used in Germany and Texas. And apparently the one in Germany, up to 60% of what's being tested right now is being rejected. So that is a potential really bad sign for production. Potential. I don't know that it actually is. I don't know what kind of stresses they're putting them through when they test them, but right now, 60% of those molds, at least the rumor is, they're being rejected right now. That could have some impact. So delays such as COVID-19 lockdowns, shortage of semiconductors, those are all important to investors as well. Although the semiconductor shortage is beginning to wane, also what we may see is further supply line disruptions because of COVID-19, adding more inflationary pressures. So Toyota did miss estimates. I don't know if you guys looked at that article, but regarding demand, Elon Musk has said repeatedly that Tesla can sell all the vehicles it can make. In addition, he said that lead times to purchase a Tesla, which can stretch 8 to 9 months depending on the model ordered, are too long. And investors would like to see an update about lead times and ordering patterns, given rising prices and rising interest rates. Prices might not rise for much longer, going back to Musk's prediction that commodity prices are falling and maybe inflation has peaked. This could presage a pricing peak or even a price cut. That is something that Elon Musk has demonstrated he's willing to do in the past, that as Tesla's prices decline, they do cut back. Commodity prices decline, they do cut back on price. So bears will likely argue that any price cut signals weak demand, while bulls might predict that falling prices will boost sales and ordering rates. You know, I just had someone visit from out of town, from another state, and visit Southern California, and part of this was my urging, but we were not necessarily counting all of the Teslas and all of the electric cars out there. But he definitely noticed that they make up a significant portion of the vehicles you see on the road right here. Demand is also spreading across the country right now. I know plenty of people now who have made cross-country trips in their Teslas using superchargers the entire time. The age is upon us, folks, and everyone talking about. I hear a lot of people who want to resist the sort of electrification of transportation. You know, dinosaurs went extinct for a reason. It's, the environment changed and they couldn't compete anymore. And I think that's a lot of what's going to happen here with the electrification of transportation. A lot of folks are going to get left behind. So definitely one of the things we should be taking a look at. I predicted that by the end of next year, Tesla would have almost a capacity of about 2.8 million units. This is saying that Tesla, when fully ramped up, can probably produce 2.1 million units annually from its 4 plants right now, with room to expand to perhaps 2.4 million units with incremental improvements. Wall Street expects Tesla to deliver about 2.1 million vehicles in 2023. The company wants to grow production volumes by 50% a year on average for the foreseeable future. There may have to be another plant or significant expansion of an existing facility by the middle of next year. And I would expect that a new facility, I think they want diversification, geographical diversification. They may end up building a second plant in China. I don't know, maybe in the Guangzhou region or the Pearl River Valley region, which is a major exporting area, and it's close to a lot of their supply as well. But the big news is, of course, is that at the meeting, Tesla investors are also going to vote to authorize more shares outstanding. The vote's going to pave the way for a 3-1 stock split. This is a foregone conclusion. It's going to happen. Investors love stock splits, believing that they signal optimism about the future. It doesn't always mean that the stock is going to rise in response to the split. That doesn't always happen, but with Tesla, it looks like it's fairly likely to happen. So, but the percentage of shares available for trading and held by non-institutional investors. That's interesting. So 46% of Tesla is held by non-retail investors. That's something I wasn't aware of. If you look at a company like Alphabet, which is Google, of course, only 15% are held by non-institutional investors. This is probably one of the things that drives the volatility of Tesla, is the fact that so many of the holders are actually retail investors. So this article says that annual meetings can be dry affairs. I don't find them to be dry at all. Well, especially not Tesla's. Tesla's tend to be a little bit more interesting, largely because Tesla stock is heavily owned by retail investors. This is kind of a crowd-funded company in a lot of ways. So, so that's one of the things we definitely want to take a look at. You guys feel free to fire away with questions anytime you like. I do want to cover kind of an opposing view right now. This is from Bob Prince from Bridgewater. Going back to controlling inflation, this is the concern that I have with controlling inflation. I'd almost rather see a really short, sharp, deep recession in order to, tame the dragon of inflation here. But it doesn't seem to be clear that anyone really has the political will to do that. And there shouldn't necessarily need to be a political will to do that. It should be a decision based solely on fundamentals. But this is kind of the problems that we're having today. So today, our indicators suggest an imminent and significant weakening of real growth and a persistently high level of inflation, with some near-term slowing from a very high level, meaning that it's going to continue. We're going to have moderate inflation for quite some time. Combining this with what is discounted, meaning what's already been priced into the market, the difference between what is likely to transpire in the near term and what is discounted is the strongest near-term stagflationary signal in 100 years, shown below. Longer term, as we played in our minds, we doubt that policymakers will be willing to tolerate the degree of economic weakness required to bring monetary inflation under control quickly. More likely, we see good odds that they pause or reverse course at some point, causing stagflation to be sustained for longer, requiring at least a second tightening cycle to achieve the desired level of inflation. A second tightening cycle is not discounted at all and presents the greatest risk of massive wealth destruction. Meaning that right now he thinks the market has probably discounted or priced in the idea that the Fed is going to raise the short-term interest rates to somewhere between 2.25% to 2.75% by the end of the year, maybe up to 3%. And I don't think that's going to happen. I think it's actually going to be higher because it's going to take a little bit longer for inflation to be tamed. He thinks that, or at least the team there at Bridgewater Capital thinks that the policymakers are not going to be able to tolerate a deep recession. They're going to kind of lose their nerve, pull back a little bit, increase liquidity, and then we're going to have to go through this again, a year and a half, 2 years, 3 years from now in order to really tame inflation. The target rate for inflation is somewhere between 2% and 3%. Even a sustained inflation rate of 4% to 5% would be too much in a lot of ways. And it also would cause a lot of price instability for a lot of different assets. It's very difficult to determine future values if you don't have a predictable inflation rate. And I do agree that if we have a second tightening cycle, that is a huge risk for the economy right now, because right now we're only pricing in what we think the Fed is going to do in the short term to tame inflation. And most people think, and this is based on surveys that have been done recently, that most people think that inflation is going to get better by the end of the year. I think that's a little optimistic. It's going to take a while to tame inflation because it is a self-feeding mechanism here. So global leading stagflationary pressures versus what is discounted. I'll be honest with you, I'm not exactly sure how they came up with this graph, so I'm not going to comment other than it's a big giant spike, right? But no, so I'm not going to comment on that. So, and leading estimates of inflation and real growth clearly paint the dilemma, as well as differences in the degree of stagflationary pressures across economies. So that the thing that I have a problem with this article is they don't really define what what stagflationary pressures are, meaning like what numbers are you looking at for me to determine what stagflationary pressures are. So, so there's a mismatch between what is discounted and what likely presents substantial ongoing risk to assets. The following table shows historical returns of assets in stagflation and is compared to the rest of time. Equities have been the worst performing assets in stagflationary time periods. So we're looking at inflation-linked bonds and stagflation about 1% in other period about 0.5. Gold really doesn't perform all that well in stagflationary periods either, but at least it keeps up with inflation, or at least it's a positive return. Broad commodities, of course, we're looking at equities at averaging negative 0.72% return on an annual basis. The Sharpe ratio here, we're basically looking at the amount of return here for every given level of risk. And for alpha here, we're looking at excess return over the amount of risk that you're taking here. And the numbers look best for gold and broad commodities in inflationary periods when we're looking at alpha here. So, no, very, very interesting look here. And look at in a stagflationary environment, your excess return based on the amount of risk that you're taking is negative 10.2% for equities and negative 13.8% for real estate, which is actually kind of surprising, I think. So I thought it would have been a little bit better than that. But yeah, so not looking very good. Didn't mean to be the bearer of bad news here, but definitely not looking very good. So in the UK, we've been told to expect 65% energy bill increases in October, followed by another increase early next year. It's predicted the average home will be paying well over £3,000 per year. Wow. So if you're in the American South, in a lot of cases, you're paying more than that for energy if you have to, if you have to air condition your home all of the time. I imagine because most homes in the UK don't have air conditioning. I imagine a lot of that is heating bills. We're seeing increases here too in utilities, but not quite as high as that. Largely because our energy supplies are fairly diversified. They're actually more diversified than people think they are in terms of where we get our energy, how we get our energy, and how we're generating it as well is fairly diversified across the United States right now. So most states have an average of 24 to 27% of the electricity they produce coming from renewables at this point, and that's one of the things that a lot of folks don't, probably outside of the United States in here, don't understand as well. So so rising utility rates are a concern. I think they're more of a concern in Europe at this point, largely because I foresee as a geopolitical measure, I see gas prices or gas being further restricted in Europe here in the near future. Fire away with questions, guys. I don't have many people on the live stream today. And I guess this is kind of more of a boring topic, but it's really pertinent in terms of future investing. So let me see here. Michael Will says economists are suggesting inflation in the UK could hit 15% if Russia slows gas supply. I take it it's not a good time to be invested in UK stocks. So what is the forecast for US inflation? So no one should ever take the forecast for US inflation seriously. And I'm not even sure that you should take forecasts for UK inflation seriously. I could definitely see with further energy shocks coming in the wintertime, which I do believe that Russia will use gas as a weapon against Europe in the wintertime. I do see further inflation shocks then. As far as whether or not it's a good time to be invested, it really depends on what your discounting model is for assets. There are a lot of companies in Europe that are going to be doing just fine. There are a lot of companies in the European economy right now that I think represent deep value, and a lot of it has to do with your really large cap European stocks right now. A lot of them pay very nice dividends. In inflationary environments, stocks don't always do that well, but dividend-paying stocks tend to do far better. If you are looking at the Dow Jones, like say in a really long inflationary period from 1966 to 1982, the Dow Jones 30 stocks, all industrial. Basically, the Dow Jones hit 1,000 in 1966. It hits 1,000 again in 1982. You essentially had zero return over that 16-year time period. If you look at the S&P 500 in that time period, I want to say that it did about 7%. I also want to say that of that 7%, about 3% of that was due to dividends because they had rising dividends in that entire time period. As they had increased cash flows because of inflation, a lot of that was passed back on to the consumer. That is also back though when stock buybacks were not as popular as they are today. I don't know what exactly a lot of these S&P 500 companies would do if they would elect to return shareholder equity in the form of higher dividends, or they would do stock buybacks. So I tend to think that stock buybacks would still be on the menu there, but there may be a lot of really large and well established UK companies that represent a lot of opportunity right now. Excuse me, that is something I would definitely be looking at. And Michael Will, you're a longtime investor or a longtime watcher on my channel. I'm not sure if you are located in the UK or not. So the Bank of England Monetary Policy Committee expects inflation to hit 13.3% in 2022 final quarter. I want to say that is a lot of the predictions right now is that inflation in the United States has peaked. There's only like one or two places in the world right now that aren't seeing significant amounts of inflation. And Japan is one of those, and that's because it's simply not a consumer economy, not in the same way that the United States or Europe is. Yeah, is inflation used by the U.S. To help the U.S. deficit? I read that the function of government was to debase currency. Not the function of government, but the function of the Federal Reserve absolutely is to, over the long term, debase currency at a predictable rate. The rate they want to do that is somewhere between 2 and 3%. The idea is that it puts continued pricing pressure on imports to the United States and makes our exports and predictable negative pricing pressure on our exports. That is absolutely, cash is now, CDs are now, short-term bonds are now, and always will be bad investments. They're just a place to park your money temporarily. You earn a little bit of interest. You generally don't keep up with inflation. That's true when inflation rates are at 2%. That's true when inflation rates are at 9%. Cash is never the place to keep your money long term. The Federal Reserve and the IRS and everyone else wants you to invest it at all times. So listening, Jason, I just watching the earnings release. So far, no recession in Australia. Very low unemployment, which generally means no recession. So that's kind of the concern right now, is folks are looking at a stagflationary environment right now, where we have really good unemployment numbers right now, right around 3.6%. And the issue is that the labor market has a lot of pricing power right now. We're seeing a lot of wage inflation. So by that definition, we're not seeing a recession. But what does it feel like? And that's one of the questions we need to be asking ourselves right now. Is do you feel optimistic about consuming? And I feel more optimistic about investing, but I'm doing that for years down the road. A lot of short-term investors, I think, are going to be disappointed. A lot of people sticking their money in a CD right now are going to end up with less purchasing power a couple of years from now. But yeah, still a lot of cash around. A lot of government handouts. Minimum wage lifted above $20 an hour now. So in Australia, $20 an hour living wage. So government handouts were not to the general public like people think they were in the United States. I've heard a lot of people complaining about the $3,400 to $3,800 that families got, saying that is the cause of inflation, plus the extended child tax credit. It's a drop in the bucket compared to the 1 year tax vacation that people got in 2020 as a result of the CARES Act. There was a provision in the CARES Act that allowed anybody with a pass-through entity, meaning an LLC or an S Corp, to use the losses in 2020 from any one of those pass-through corporations or entities against gains going all the way back to 2016. In the past, if your income was over a certain limit, you weren't allowed to do that, and you weren't allowed to use the gains from any one entity against like another one. Like if you had an LLC that lost money in 1 year, you owned a restaurant, you couldn't use it to write off losses for your LLC that did something different, right? But they had a 1 year vacation on that rule in 2020, and I didn't get any of that stimulus, but I got a massive, massive tax return. And that law wasn't designed for people like me. It was designed for multi-millionaires and billionaires who own tons of money, or who own tons of businesses rather. As a result, 82% of the wealth from the two stimulus bills that were passed in 2020 went to the top 1%. 82% of it. It isn't the normal middle class people and poor people that got their $3,400 in federal funding, their unemployment, and all that. It is the 82% of the money that went to the wealthy. What do you think I did with that money when I got it? I just invested it. I didn't need it. I have an emergency fund that represents several years of living expenses. I just invested those funds, and that's one of the things that you that kind of blows me away about what's going on right now is that the poor and the middle class and people who accepted these little stimulus checks are being blamed for inflation right now, when that's not who got the majority of the benefit from the first CARES Act. 82% of that went to the top 1%. So, or people making over $1 million a year. So I think it's absolutely insane. So I just go Google who benefits from the CARES Act, and the Tax Policy Center comes up with an article. It's like second or third down on the list, and it details that particular tax trick. I exploited that. Like I said, though, I wasn't the target of that. That's really for people that make a lot more money than me. Sorry to change the topic. As an American, do you get a sense for the level of market penetration that SoFi has in the U.S.? Do you think people in Chicago or Miami are aware of SoFi as others in California? So that would be hard for me to judge on a personal basis. I don't think they have great market penetration outside of people who kind of like their typical person is somebody with a college degree that makes over $100,000 a year, that still has some debt, is in their early 30s, maybe he's purchased a property, maybe hasn't started a family yet. They tend to have good market penetration with that group of folks. They don't tend to have as much market penetration outside of California. So I don't know if people in Chicago or Miami are as aware of it, but SoFi was one of the big sponsors of the Super Bowl. That had a lot to do with that. That did a lot for increasing brand recognition. The Super Bowl was in SoFi Stadium. This is one of the most watched sports events. It didn't seem to have an immediate effect, but when you look at the growth of members, and SoFi really is a growth story. And man, the weird thing is I didn't get many views on the breakdown of the earnings report that I did with SoFi. And I think that's and of course, it's a 20-minute long video where I'm just explaining why things are important with SoFi's earnings. I get it; they can be dry, but seriously, that is all. Even I get nervous when my stocks are down, right? Even I get upset when I'm underwater. But reading that, I went out and I put a bunch of puts in to acquire more shares if the price drops again, and I added like 100 shares that day, which is still lowering my overall cost of acquisition. But I kept adding. But I'm going to keep adding shares while the price is low, which means that at some point I'll have to do a short-term sell if the price goes back up to $20 or something. It'll be more than 10% of my overall net worth at that point, and I don't want anything more than that. So, yeah. So earnings releases, like you said, earnings releases for companies right now look pretty good, but everywhere is showing signs of strain, and it just may take a little bit longer for companies to start showing signs of strain, or for it to be abundantly clear that the increased revenues are really being absorbed by inflation at this point. So, yeah, a lot of things going on in the economy right now. Anybody that has a high degree of certainty right now would probably be suspect to me, right? So I don't think anyone should have a high degree of certainty as far as what's coming here in the next year or so. This article here where it says protect yourself from the mother of all bear traps. I'm coming out with a video that outlines, I'm going to do it this weekend. I'm going to come out with a video that outlines how to handle putting together a put spread collar on positions that you've gained or earned a lot of money on in the last couple of months. So, why use puts and lock in a price on V? Just buy the physical, just buying a physical stock. Meaning, I think that we're actually in a bit of a bear market spike right now, or a little bit of a dead cat bounce, and we'll probably see further volatility. Like I have a place that I have a dollar amount for every stock that I buy where I think it's fairly valued, or just the price that I want to buy it at. And I'll put a put on there. I'll sell a put usually at a long range. And if it doesn't, meaning 6 weeks to 12 weeks out, and if it doesn't execute in that time period, then I got paid a nice amount of money to do that, right? If it goes up, I lose, right? But if it goes up, it was already higher than what I considered to be fairly valued, right? So I don't necessarily want to own that stock. But I'm actually talking about protecting the gains that you have in the money that you made over the last month or so. A put collar, a put spread collar is actually a pretty good option right now. Hedging has become really, really expensive in the last decade, meaning buying near the money puts has gotten really expensive in the last decade or so. I don't know why that is, but a put spread collar is a way to reduce your costs on that. In this article on Barron's, and you can look that up. This is just a great article on Barron's, but I'm going to put together a video this weekend and have some visualizations on that so you can see kind of in pictures how that works and how you can create a way to trade away a little bit of your upside potential, give yourself the opportunity to buy back the stock at a really good price, much lower, and protect the value of what you have now with a near the money or at the money put. Combining by buying that near the money, at the money put, selling a call with a delta of around 0.3, selling a put below the at the money call, something like 20% below that, you can reduce the cost of that hedge to very little, or you may actually even make money off of that. So if the price declines, you win no matter what. If the price rises, you may that stock may be called away, and you may actually have to unwind the trade if that's something that you want to do. But yeah, that's I'm just gonna put a video on that. It's hard for me to explain that while I'm doing that live. I hope I did a good job. But if you don't trade options, then you probably have not much of an idea of what I'm talking about when it comes to puts, calls, buying two puts that have the same expiration but different strike prices, how that protects you, or like buying a put rather and selling one on the same with the same expiration, how that protects you in the long run. But I'll talk about that in the video. Anyway, guys, I'm having a little bit of trouble with coughing today, and it's getting worse. I'm not going to be on much longer. So if you guys have any questions, go ahead and ask. So I think today is Thursday. Yeah, today is Thursday, which means I'll be taking tomorrow off. But yeah, fire away, guys. If you have any questions, I'll give this another few minutes. And let's see if there's anything interesting. Pelosi's annual. Wait, we're talking about Pelosi leaving China, which I think turned out to be a non-event economically, as far as right now. So this is interesting. I didn't do a lot on GameStop when this came out, just because I knew kind of exactly what it was. Coinbase has rallied 90% this week. Could it be another GameStop moment? It might be another GameStop moment, but long before, so this is a much more broadly traded stock than GameStop was. GameStop was in the beginning. I think they're going to have retail investors are going to have a lot less power. Anyway, yeah, I'm going to call it a day today, folks. I am, like I said, I keep feeling coughing coming on. So, and I am going to check out the Tesla annual meeting today, and that's something we can talk about next week. I fully expect that everything is going to go right when it comes to the stock split. So anyway, thank you very much for attending today, and I will see you guys on Monday for sure. And I'll probably be putting out a video here pretty soon.